Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Today we kick off a new group of accounting podcasts focusing on topics from our Financing Transactions Guide. In this first episode, we cover share repurchases and treasury stock. This is one of the most popular guides and one of the most popular sections of the guide, so hopefully you'll find this interesting to you.
There's really only two ways that a company can return cash to its shareholders. The first way is to pay dividends, and the second way is through share repurchases. And many corporate finance theorists and tax advisors believe that the more tax-efficient way to return cash to shareholders is through share repurchases. So that's a major reason.
That was John Horan, a managing director in PwC's National Office. He has years of experience helping clients and engagement teams with complex accounting questions in this area. John's great at helping break down the topic to make it easier to understand. With that, let's kick off the miniseries. John, welcome back to the podcast, and thank you so much for kicking off our month focused in on financial instruments and financing topics, and in particular today, talking about share repurchases and treasury stock. So I think it may be helpful before we start to get into some of the detail about some of the accounting, why we're seeing some of these transactions, and in particular with stock repurchases, why a company may want to repurchase their shares.
Sure. First thing, Heather, I thought we talked about is, corporate share repurchase remain a key financial strategy for many companies. In 23, we actually saw a decline in share repurchases. That may have had something to do with the fact that corporate profits were down in the first two quarters of 23. Another thing that happened from a regulatory perspective, the Inflation Reduction Act was issued in August of 22. I know you know a lot about that.
Yes, it's one of my favorite topics. I perked right up.
And part of the Inflation Reduction Act, a 1% excise tax was put in place on share repurchases. So my guess is that had something to do with the decline. People wanted to figure out what that was all about,
yes.
I think. In addition to that, share buybacks haven't been a really popular thing for companies to do among politicians. So from a political perspective, it's not necessarily positively viewed. And as a result of that, I think the SEC in May of 23 has instituted some new disclosure requirements around share repurchases. So despite all of that, we still do see share repurchases happening. Beginning of this year, first quarter of this year, many of the analysts were predicting a recovery from the waning of share repurchases in 23. So I guess that remains to be seen.
Well, and John, I think it's interesting when you talk about a rebound in 2024, because we saw with that SEC rule that was issued in May, then there was litigation, and then ultimately we saw that it has not become effective. And so when we think about a rebound in 2024, there's a lot of different pieces that potentially are impacting that.
Yeah, and including how companies are performing in 24 as well. I think.
Yes, fair enough. So then, if we take a step back and so move past what's going on from a broader environmental perspective. If I'm in a company, what are some of the reasons that I may want to move forward with a share repurchase?
I think some of the primary reasons are there's really only two ways that a company can return cash to its shareholders. The first way is to pay dividends. And the second way is through share repurchases. And many corporate finance theorists and tax advisors believe that the more tax-efficient way to return cash to shareholders is through share repurchases. So that's a major reason. The other is, by pulling shares out of your share count, you increase earnings per share and dilution of the stock, which can positively impact a company's stock price. Another reason is, especially for companies that have significant stock compensation plans, option plans, where shares are getting issued as compensation to executives and employees, many times share repurchases are used to offset the dilution that company incurs as a result of those plans. And finally, having been a finance major in graduate school, A very important reason is to optimize a company's capital structure. So the CFO and the treasurer of a company normally have a view as to what the optimal, it's usually a range, but the optimal capital structure of a company looks like in terms of how much debt and how much equity. And so share repurchases can be used to tweak that optimal, the capital structure to the point that they believe is optimal.
It's interesting, though, John, when I think back to the sort of broader environment we were talking about and that these are less popular from a political perspective, it's because they would rather see that capital being deployed in some other way rather than just buying the company's own shares.
Yeah, absolutely. I mean, certainly, they believe there's some companies that buy back shares at the to the negative impact to employees and things like that. That's the thought process. I would say the ones I just mentioned are probably the primary reasons, but, many companies, many C-suites look at it and say, hey, share repurchases send a signal to the market that we're high on our stock, that we think it's undervalued.
Oh, yeah.
And to a lesser extent, they can be used to help present hostile takeovers. We don't see too many of those anymore. Yeah. The cowboy days of the 80s are gone, I guess. But, and then, repurchasing shares from major stockholders, those types of things are also out there.
So I know that there's a lot of different ways companies can sort of enact a share repurchase program. What are some of the sort of typical ways we do see that?
A lot of there are 4, 5, 6 different ways that companies do share repurchases, and a lot of this has to do with laws and regulations around the share repurchase. Some of them have developed to help companies alleviate some of the risk when they go out and buy their own shares in the market. A couple of things about share repurchases. First thing is a company needs to get approval from their board of directors to do it. And typically they'll go get a resolution to the board. It typically sounds something like, we authorize the company to repurchase $300 million in shares over the next 18 months. And then management of the company is free to go and figure out exactly how they're going to do that. In addition, when a company engages in repurchase of its own shares, they have to act in good faith, right? And so there are some rules and laws. I'm no lawyer, although sometimes I feel like one. But I'm not a lawyer. But there are rules around when and how a company can repurchase their shares. And as a result, there are certain safe harbors that exist. And in order, the rules around the safe harbors, contain certain conditions. Those conditions include the manner in which the repurchases are conducted, the timing of the repurchases, the daily volume of the repurchases, and of course the price at which, those repurchases occur. And so as a result of that, there are different plans and processes that have developed. I think a very common one and something we see quite a bit is just plain vanilla spot repurchase of company shares, right? And in this case, company just has a broker. They put somebody internally in charge of making sure they're complying with the rules and regulations, and that person makes a decision. This is a good time to buy our shares or a bad time to buy our shares. Pick up the phone, similar to the way you and I would with our personal broker. Pick up the phone, call the broker, and execute a trade in their own stock.
Oh, this sounds like it could easily run into some pitfalls, but anyway, keep going, and then we'll talk about the accounting implications. Let's assume they execute it in accordance with all the required, to your point, regulations.
I would say you should be fairly experienced at this.
Yes.
But it happens. We do see it. And secondly is one of these plans that would qualify you for a safe harbor. It's called a 10b5-1 safe harbor plan.
All right. Important to remember.
Sexy name.
Yes.
But what it means is I'm going to go to my broker, my investment bank. I'm going to establish a plan with a formula and a dollar amount for them to purchase stock over some period of time. Call it 3 months. Mm-hmm. And we'll give them a plan and a formula that says buy our shares given these circumstances. We give it to them contractually. The plan is irrevocable. And the broker goes out and executes the trades. Now, typically it would be for $1, and we may go to that broker and say it's going to, we want to buy $100 million of shares pursuant to these parameters over 3 months. And the broker will go out and pay attention to what those parameters are. But it's not solidified in stone that they'll actually purchase shares because the parameters may never be met. But it does protect the company from some of those compliance issues that we talked about. Not all of them, but some of them.
Yeah.
Another way to do it is just a plain old forward repurchase contract. So you go to an investment bank, you enter into a trade with the investment bank to repurchase your shares, or could be other than an investment bank as well. It could be a major shareholder. And we're going to repurchase these shares over some period of time in the future. So that's another way that we see companies do it. There's also, this is probably a less common item, but we see it, and it's a self-tender offer. So the company can go out and make a tender offer for their own shares in the market broadly to their shareholder group and repurchase their own shares that way. And finally, this one gets a lot of press in the accounting world, and it's called an accelerated share repurchase plan. An accelerated share repurchase plan is basically a plan typically executed through an investment bank, where we go to the investment bank and legally what the contract says. And we'll talk about the accounting later. But legally, what the contract says is, we'll give you $100 or $200 or $300 million today. You're going to deliver a stipulated amount of shares based on the stock price on the day we enter into that contract, today or tomorrow. And then we'll settle up on that based on the average price of our stock over the period of the contract. That contract, I would say typically they're 1 to 3 months. But in particularly large deals, they can be 6 months or 9 months. And it also depends on the liquidity of the stock because, only so many shares, you're only allowed to purchase so many shares of your stock in a day. And if the investment bank is out there buying shares. So those are the primary ways. There may be others that companies go about it.
So, John, I think part of the reason it's important to understand the way is because they do have accounting implications depending on the approach you've taken. Am I correct? Okay.
Absolutely.
All right. So why don't then we walk through each of them a bit further? And we can start with one almost give me the heebie-jeebies because of the number of things that could go wrong. But this idea of the spot repurchases within, the company itself executing on that.
Yeah, think about the way when you call your own broker to execute a trade. I don't know. You look at it and you say, I like this stock.
Yes.
Pick up the phone. Can you buy me this stock? I like it at $20. Broker says, okay, we'll see if we can do it. He goes out, does whatever he has to do in the market to see if he can buy it at $20. He calls you back and says, all right, you're done at $20. And then the trade settles 3 days later, 2 to 3 days later.
Yeah.
I think it used to be 3 days. It's 2 days.
I think it's now 2 days. Yeah.
So same thing for a company doing a spot repurchase. Pick up the phone, call the broker. Want to buy my own, X amount of my own shares at this price. Broker calls he or she back and says, okay, you're done at, $20, $30, $40, whatever the price of the stock is. And then 2 days from now, I deliver cash and they deliver shares. So if you think about that, what that really is a forward purchase contract.
Yes, a very short one.
Very short one,
yes.
But it's a forward purchase contract. So we would say, we get a lot of calls. Hey, we just did this spot repurchase. Should we account for it on trade date or settlement date? Tell me about the trade.
Yes.
And if it's the trade I just described, we have a contractual obligation to deliver a fixed amount of cash for a fixed amount of shares in 2 days. Sounds like a forward purchase contract to me, right? So the accounting for that, there's a special accounting in ASC 480 for repurchase of your own shares where it's a fixed dollar amount, fixed price, payable in cash, unconditional on a fixed date. And that is, we're basically going to assume we repurchase the stock today for a liability. And so that's the accounting for that trade. We would debit equity, credit liability for the discounted amount of that liability, and then we'd accrete interest over that 2 or 3 day period. Now, I don't know that anybody gets too excited about that, but that's technically the accounting for that trade.
But so then in the end, sort of the net impacts, then you settle your liabilities. So ultimately, you are winding up with a debit in your
Treasuries,
equity,
and
a reduction in cash, basically. All right. So that's the first one. And then from a practical point of view, unless that's happening like 1 day before the end of the period or 2 days before the end of the period, it really wouldn't have a big accounting impact. Is that fair?
It's true. You would the only thing would be the interest amortization, which on a 2 day contract is probably not a boatload, unless it's a really, really big trade.
Unless it's a really big trade.
Yeah, absolutely. But believe it or not, we do see situations where it happens over.
That period. And then in which
quarter
case it's important to get the accounting. I mean, always important to get the accounting right,
Yeah.
but particularly important over the end of a period. So then let's move on then to the ones that were more systematized with the fancy name, the 10b5-1 plans.
Yeah. Again, this is we've given the broker, the investment bank, some instructions to execute trades according to certain parameters. We have given a dollar amount. We want to buy $100 million in shares. And so when I get a call and they start saying, hey, we're repurchasing shares, I start asking questions like, well, tell me about the plan, and many times it's one of these plans. And so this is, should we be debiting equity and crediting liability for $100 million? Because that's, no.
You haven't done anything yet.
Wait till the broker calls, tells you that he's executed a trade. At that point in time, it's the same thing as the spot trade. Are we unconditionally obligated to deliver cash in 2 or 3 days for a fixed number of shares on that fixed date 2 or 3 days from now? The answer to that question is yes. Then we debit equity at that time, credit liability. So that's going to be staggered for the reason you said. We may never get executed if the parameters are never met. Yes. So it's very similar accounting to the first one, but you've got the protections of
making sure that someone else is making sure you comply with all these requirements. So then how about then the forward repurchase plans? This is the ones I think that you said are also more exciting from an accounting point of view.
Yeah, I mean, the forward repurchase, again, the spot trade is a forward repurchase. So if we have a forward repurchase, again, that's just a longer period of time. Let's say it's a month down the road or 2 months down the road. It's the same accounting. The only difference is more likely to cross over quarter end, and that discount that gets created is going to be more significant. But essentially, the accounting is the same for those trades. Now, they're not all that clean.
Of course not. We wouldn't be having this podcast.
So if you've got physically settled forward contract, the first question is it fixed price, fixed date, cash, right? If it is, we're in the model that I just spoke about, right? So talking about initial recognition, if it's other than that, let's say it's fixed number of shares, but the date isn't fixed or the price isn't fixed for whatever reason. What the standard, but it still has to be physically settled, right? And it's unconditional. It's going to happen, right? We would still debit equity, credit liability, but the subsequent measurement of that instrument would be different than just accreting over a period of time. What we would do is at the end of every reporting period, we would say, let's assume this is the settlement date of the instrument. How much would I have to pay if today was the settlement date of that instrument? And that's what I record my liability to. And the difference between reporting periods goes to interest cost. So that's if it's physically settled, unconditional, settlement date varies or price varies.
Okay.
Now, we also see contracts that are net cash or net share settled. So that means we don't definitely know,
right,
that shares are coming, all the shares underlying the contract are coming back. Net cash settle means, the counterparty could just settle up by giving us cash or us giving them cash. Net share settled is the same thing, except it's a variable number of shares equal to the intrinsic value of that contract. And so in those cases, the initial recognition for the contract would be fair value, and subsequent measurement would also be fair value with changes in fair value through earnings, derivative-like accounting.
So then how about another scenario I think we would see, which would be this prepaid that you talked about, where so basically you are paying now for something that's going to happen in the future.
Yeah, this is just a forward purchase contract. One different, instead of being postpaid, let's just say it's for a month from now or 2 months from now. Instead of being postpaid, we prepay the exercise price. Why would a company do that? Well, it gets you out of 480.
Yeah. Okay. Which we know is complicated.
So the reason that you get out, because 480, in that situation, all that's going to happen is we're just sitting there waiting with a catcher's mitt for shares to come back.
Right.
Right. There's no obligation of the company. We've already prepaid the contract. And so we would not be a liability under 480. However, one would look at that and say that, well, isn't that really a loan with an embedded forward purchase contract? And so you need to run the forward purchase contract through a 1540, which I know we just finished another podcast telling everybody all about that.
Yes.
But assuming you passed through, and many of these trades we do pass, they're intended to. And so assuming you pass through 480, we would say, well, the substance of this transaction is a treasury stock transaction, and therefore the asset that we've created by prepaying the exercise price can get classified in equity.
All right. So then all of those have sort of, I'll say, similar implications. But then how about, let's go down the one you said you don't see very often, but this tender offer. What are the accounting implications of that?
The tender offers are very, very highly regulated transactions. And because the SEC wants to make sure that all shareholders are being treated fairly. There are lots of rules around tender offers. And we see tender offers, we have clients, that are U.S. registrants. We have clients that are publicly traded in other countries' markets, or subsidiaries that are traded in other countries' markets. And the rules are different between countries. Very important to understand the rules. But in the U.S., there's some rules. One of the rules is that tender offer has to be outstanding for 20 days. There are others, and they're all designed to make sure that all shareholders are treated fairly. Again, I'm not a lawyer, but I do know that exists.
Yes.
The key in a tender offer is understanding when the company, they have rules around, when they announce it, how they announce it, how it gets communicated, things like that.
Yes.
But once that's done, the key is understanding what are the obligations of the company that's making the tender, and what are the obligations of the shareholder who's the recipient of the tender offer. So, for example, if the company was unconditionally obligated after making the offer to repurchase shares, assuming they were tendered by the investor, but the investor is not obligated to tender, it sounds a lot like a written put, doesn't it? So we've obligated ourselves to repurchase the shares, but the investor's not obligated.
Mm-hmm.
And so a written put under ASC 480 is an instrument that needs to be marked to market. It's also important to understand, usually the tender offer rules state that that investor, let's just say the tender offer period is 20 days or 30 days. It has to be a minimum of 20 is my understanding. The investor can say on day one, okay, I'm going to tender my shares. But he or she is not normally obligated until very, very close to the actual tender close date. He or she can withdraw that tender offer up until very, very close. Might be a day or two before the tender is due to close. Typically, that investor is not obligated for that period of time. We do see arrangements, however, where for various reasons, one investor may obligate themselves for whatever to do it. We've seen, lots of different variations.
Yes.
So you do need to understand all of the legal details around these trades and understand, do I have a written put? Do I have a forward purchase contract, or do I have nothing? And, we do see tender offers where the material adverse change clauses are, pretty broad, or allow people to get out of those trades. And we've seen other situations where it appeared that the issuer was, or the company was obligated. So very, very important to go through all the legal details in those tender offers.
All right. I think that's the theme.
And conversations with lawyers.
Yeah. Make sure you involve lawyers and just don't rely on what John is telling you in this podcast. So then you mentioned this last type, the accelerated share repurchase. There is maybe, quote, more exciting from an accounting perspective. So how would we think about those? Yeah,
these are, very popular. For a couple of reasons. The first reason is when you enter into, remember, this is the contract we enter into where legally what we've got is a contract to purchase a fixed dollar, usually a fixed dollar amount number of shares over a period of time at the average price for the period. From an accounting perspective, we break that into two transactions. Normally, there's a delivery of shares on day one or the day or immediately after we execute the trade. So those shares come out of share count immediately. And secondly, if you're a treasurer and you're worried, about how successful you're going to be in repurchasing shares at a reasonable price, this guarantees you that you're going to get the shares over that period of time for the average price of the volume-weighted average price over the stock. That's attractive to a lot of treasurers. So in fact, the investment banks, can structure the transaction such that you actually are guaranteed to do a little bit better than the average price over the period of time. And you do that by writing certain options to the investment bank in that trade. But if my objective as a treasurer is to, repurchase the shares at better than the average price over that period, I just guaranteed it.
Right.
So that's why I think it's a popular trade, amongst, corporate finance folks.
So then, John, if you have all these other features that are included, then the accounting must have some additional complexity.
It does. It does create some complexity. Like I said, this is broken up into two trades, right? So let me tell you what a typical ASR looks like that we see. The most common is company decides they want to repurchase $100 million worth of shares. So they execute the trade with an investment bank. It's going to be for 2 months, let's say. And the investment bank delivers to them a number of shares immediately after executions. Typically 80 to 90% of the shares they would get for $100 million at the spot price on the day they entered into the trade. We refer to those as holdback shares.
Okay.
Right? So the 80% of the shares that we get, we account for that just as a treasury transaction. We debit treasury stock, right, for the amount, the fair value of the shares, which is, the price on the day that we executed the trade. The next part of the trade is a little more complicated, right? Because of those holdback shares, right, we've got an interesting, very complex derivative. And basically what that derivative is, it's a forward sale on the entire notional of the contract versus VWAP over that 2-month period, and a prepaid forward purchase on the holdback shares, all mashed together in one big, ugly derivative.
Yes.
And so the accounting, for this requires us, unfortunately, we're back in our good friend ASC 480. Why do we need to think about this under 480? Well, because even though, the likelihood that stock price will increase to a level that we would have to effectively deliver shares to the investment bank to settle the transaction, probably very unlikely given that we held back 10 or 20% of the shares, right? Most likely we're going to get shares. But if the stock price does increase, it's possible we could have to deliver a variable number of shares to the investment bank. And a forward purchase contract has a payoff profile where the obligation of the company is inversely related to its stock price. So in other words, my obligation increases if the stock price goes down. That's a bad guy.
Exactly.
Under ASC 480,
Yes.
right? So we have to do a predominance test on that. And so if the forward purchase aspect of that contract is predominant, that complex derivative would be an asset or a liability. In my example, it'd likely be an asset.
Okay.
Right? And it would be mark to market. The reality is, even though you have to go through that pain of doing the predominance test, most of the time, the forward sale aspect of the derivative is more predominant than the forward purchase contract. So you typically don't get caught in 480.
Okay.
Although I've seen it get close.
Close is not the same as actually happening.
Close but no cigar.
Exactly.
So the second part of the analysis is we got to go into ASC 81540. Because we're a public company, shares underlying this derivative are publicly traded shares, readily convertible to cash. We're going to meet the definition of a derivative, right? So we got to determine whether we can get the own stock scope exception. And so I know we just did a whole podcast on this, but that analysis requires us to determine whether this contract is indexed to our own stock and whether it passes all the criteria that we need to think about in terms of whether it should be classified in equity. And, we see contracts that have provisions in them that would cause us to say that the contract is not indexed to its own stock. So I do think we said this in the last podcast. It's important to have experienced eyes look at these transactions.
Yes, definitely. I mean, it's definitely very complex. So then, John, let's presume you listened to the other podcasts, you made it through, and now you have equity classifications. So what are the next steps?
Yeah, so it's interesting. Think about the day one accounting first on in my example, where it was a $100 million trade. I know the credit, that's easy. Credit cash for $100 million. I'm going to debit treasury stock for the 80% of the shares, fair value of the 80% of the shares I receive. The other debit, assuming I get through 81540, is to equity. So my complex derivative is going to get equity classification. Day two, the most likely scenario is I'm going to receive shares from the investment bank. Again, I'm going to record those shares at the fair value on the day they're received, and I'm going to credit equity.
All right. So then, John, let's assume whatever route we took, we now have the shares. So how do we account for our treasury stock?
There's a couple of different ways that we can account for our treasury stock.
Of course. It can't be straightforward if it's one of these topics.
So the first thing is you really need to consult legal counsel. But one of the most common ways that companies account for treasury stock, when they receive the shares, they debit an account, treasury stock, and in their balance sheet, they just show it net for the amount that they paid for those shares in stockholders' equity. And the caution I would say there is, and again, you really need to speak with legal counsel, because there are states, depending on what state that corporation is incorporated in, there are states that don't let you debit treasury stock.
Oh.
They essentially force you to do what we call constructively retire the shares, which would mean you'd actually debit your par and debit your APIC in a manner that we'll talk about in a minute or two. So there are states, there's not a lot of them, but there's a few that require you to constructively retire shares. And Delaware is not one of those, by the way.
All right. So if you're incorporated in Delaware, you're safe. So assuming you don't have to constructively retire, then what do you do?
You just debit treasury stock for the fair value of the shares, and we would have credited cash. Yeah.
All right. So that's easy enough. And then I guess ultimately you could actually retire those shares if you want to. But then in this constructive retirement, what does a company need to do?
So this is where, it's important that you have good control over what you've actually placed in equity when you sell shares or deliver shares pursuant to, compensation contracts and things like that. There's two methods that you can use to constructively retire or retire your shares. Obviously, we're going to debit par, assuming there's a par value for the stock, right? That's a minimal amount. Secondly, we can either debit the entire amount that we paid in excess of par to retained earnings, or we can allocate the amount that we paid between APIC and retained earnings. And the amount of APIC that we can charge for the repurchase of those shares is really based on how much APIC we created.
When the shares were issued.
When we sold the shares. So typically what I've seen is companies keep a running average, I call it the average cost, but it's really the average amount that they put in APIC for all of their share issuances. And when they pull it out of APIC, they pull it out at that average amount and keep a running total of those shares.
Yeah, because that seems advantageous versus reducing the entire amount against retained earnings. Sometimes you can run into trouble, right? If you don't have a lot of retained earnings. So,
well, and also if you think about it, when companies have ongoing share repurchase programs, assuming their stock price is increasing over time, they're definitely pulling it out at more than they sold it for. Yeah.
Right.
On average over time. Right. So you could end up with accumulated deficit, and we see that.
Yeah. So definitely something to be very cautious about. All right. Well, a lot to think about here. Again, to your point, this is something we're seeing more, so it's important for people to make sure they're paying attention to the guidance. So 2 final questions for you. So first one is just dealing with these types of transactions. I always have to ask, what's your words of wisdom?
Well, there's one more thing I do want to mention.
Oh, okay.
And that is, if we run into a situation where our retained earnings, if by repurchasing shares we put our retained...
that you actually do go negative.
If we put it, So what we say is there's a SAB topic. It's called SAB topic 3C. And that SAB topic deals with deemed dividends on preferred stock. But basically what it says is when you have a deemed dividend on your preferred stock, you would debit retained earnings until retained earnings is zero. And then when retained earnings is zero, you would debit APIC. And then when APIC is zero, you would debit accumulated deficit. And so we think a reasonable way of dealing with this is when that would happen through a share repurchase, analogized to that SAB topic. And so in that case, we would debit, the excess over par and APIC, assuming you're in the allocation method, would go to retained earnings till retained earnings was zero. Then we would debit APIC to the extent there's APIC of that same class of shares. And then any excess over that we would put to accumulated deficit.
All right. So lots to think about.
But again, it's an analogy to
yes. Well, it's also interesting to think if a company is going to flip into an accumulated deficit by repurchasing shares. It's just an interesting convergence of events that you would have that.
Right.
Yeah. All right. Well, so John, as always, very nice to talk to you. This is relatively more straightforward than some of the other topics I know we're talking about this month, but nonetheless, still quite complicated. So what are the words of wisdom that you would have for our listeners?
I think I already mentioned it in this podcast. I think it's important, particularly on the more complex derivative-related trades, to make sure, you have all the contracts. Make sure you read the contracts very, very carefully. And it's always good to have some experienced eyes look at it. That's my advice. And
in this case, for our listeners, if you'd like to read about it before you talk to some experienced eyes, you can look in Chapter 9 of the Financing Guide. Yeah. So, John, as always, such a pleasure to talk to you. And thanks so much for joining me today.
Thanks, Heather.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.